Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views. Hey, good morning. Happy Wednesday, Fed Day. Later today, we're all going to get that exciting news. So we've got, start with the macro a little bit. Durable goods came in at 1.9% this morning. That was versus a negative 0.4% expectation. Much stronger than expected. I think one of the best reads of the year. And maybe my thought is maybe that's some supply chain catch up, if you will. Still got a lot of goods that are, making their way to their destination that should have been there 6 months ago. That's probably part of it. And interestingly enough, the long treasury, the TLT, traded higher after that number came out, which would, in my mind, suggest that, in fact, it is kind of current demand is not so much reflected by that 1.9%, and maybe that really is more of a catch-up type of phenomenon. Just kind of an observation there. Google, Microsoft earnings came out better than feared last night. I don't think there's anything to do there right now. For me, I still think, the companies did point out metrics that are deteriorating for them fundamentally. I don't know if that changes right now. I'm not sure that, the numbers they are guiding to are going to necessarily be achievable for the balance of the year. So not doing anything there. We do own both of them, but we own relatively small positions, and we're going to stay put for now. Spotify was interesting. They continue to beat, surprise on the upside with subscribers and minutes used and all that stuff. There's a level of confidence that management team has in their product and what they're doing. In terms of they are the premier podcast destination, the music service. Now they're going to do audiobooks via acquisition. I think it's interesting. I think it's at under 2 times sales. They're not profitable, unfortunately. No, the free cash flow is not quite there yet, but they did allude to raising prices in the future. Not quite, not now with the macro still deteriorating. That would not be smart, and I'd agree. But they are going to be raising prices at some point. I don't know. We've got a small position there. We trimmed it recently just on the thought that anything's possible in this tape. So we got a smaller position, but we're still involved. Going to stay involved and look to add. Looking to be adding. When it makes sense. Med device. This is a theme that I've been working on for a little while now. So we had Boston Scientific report, BSX, as well as Stryker, 2 very different businesses, but nevertheless, both in the med device realm. Boston Size looking up 5% this morning on really a not exciting quarter. They missed on both metrics. They took the guidance down a little bit. Stryker, kind of the same thing. They didn't miss quite as badly, but they did take the guidance down a little bit. But these stocks are looking up 3 and 4%. I think this goes back to what I was talking about before. I think you're going to see increased procedure volume, elective and non-elective, the rest of 22 going into 23. These stocks have not participated, unlike large pharma. So this realm of healthcare has been definitely a laggard, and I think it can really assert itself here. The IHI is a ticker. It's an ETF for the med device space. We are long. It is one of our larger holdings. Looking up about 1% this morning. I don't know. I like it. The chart's starting to look really good too on the IHI. You got the 20-day starting to move up over through the 50-day moving average. This thing looks like it wants to change trend. It looks like it wants to get out of this downward trend. I think it's interesting. You got the defensiveness of healthcare. You've got less COVID patients in ICU beds, so you got open space up for elective procedures and other procedures. So people getting their pacemakers, people getting their new knees and their new hips, all that fun stuff. That stuff can go on now, and probably more so going into 23, hopefully, without a resurgence of COVID, knock on wood. So that's it. I like it. We own it. It's one of the things I'm probably most excited about right now on the long side, just given I think it is an inefficiency out there in terms of how poorly those stocks have done, and yet what looks to be a more favorable future ahead, and not a commanding valuation for anybody out there, outside of maybe Intuitive Surgical. Fed today, we think 75 bips. We think it's still going to be a hawkish tone, so I don't think you're going to get your pivot today. So I could be wrong, but that's my guess. I think that's more a September type of a trend. So that's it. Good luck out there and have fun. Talk to you tomorrow.
And now for some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with investment objectives similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.